double entry, and we are working with stock, and we're going to look at an example of cash sales, and that's when we sell stock for cash. All right, so let's take a look at this example. Oops, it doesn't have a date. So let's say January 4, 2016, sold goods for cash. Now, once you hear sold goods, then we know that is sales from our previous lecture. So once we hear sold goods, it's sales. Remember, every transaction affects at least 2 accounts. In this scenario, the 2 accounts that are affected are sold goods, which is sales, and cash. So just right here, the sales account and the cash account. Now, what type of account is the sales account? We know it decreases inventory, how we sell goods, but sales account is also a revenue. It's a revenue account. And cash account is an asset. It belongs to the assets category. Alright? So remember, it's important for you to know how to identify the categories that the accounts belong to. So now, these are the 2 accounts affected by this transaction. Sales, which is a revenue, and cash, which is an asset. So the next question is, what is the double entry rule for revenues? What is it? For revenues, double entry rule says to increase, credit, and to decrease, debit. Now, when we make a sale, are we increasing the amount of income that we've earned in the business? Yes, we are. As a matter of fact, you cannot reduce a revenue. You cannot unearn what you've already earned. It's pretty much the same as an expense. So the sales account is always credited because you can only but increase your revenue. You cannot unearn your revenue, right? So to increase revenues, we credit. And this transaction is increasing our revenues because we're selling goods, right? Sales is increasing. Sales is a revenue. To increase revenue, you credit. So we make a credit entry in the sales account. We see January 4, the next account affected by this transaction is cash, and the amount is $18,000. So let's move over to our cash account now, which is an asset, as we've established before. What is happening to cash as a result of this transaction? Is it increasing or decreasing? We're selling goods for cash, which means we're going to give the goods and get cash. So it means that cash is increasing. Cash is an asset. The double entry rule for assets says to increase, we debit. So we debit the cash account. January 4, next account affected is sales. The amount, $18,000. And that's how we record this transaction. Remember, sales is a revenue, and you need to know the double entry rules for all the 5 different categories. And there's another reason we credit sales. Remember, sales decreases inventory. Inventory is an asset. To decrease an inventory, we credit. To decrease an asset, we credit. Toodles.